Hey there, everyone. Happy Monday. Just want to send you across your weekly update. Hopefully, everyone is staying warm this weekend with the winter storm that came in. It's kind of freezing. I went for a walk yesterday and couldn't feel my fingers. But anyway, let's jump into the market update. So, first thing, looking at the big headlines, what this means for Houston. So, inventory did rise modestly this past week. Not surging, sitting around roughly about 50,000 active listings, up from this time last year, which kind of points to the market kind of normalizing rather than just being oversupplied. So if you look at this table, this is from December 2024, active listings with 45,000. This year, around about 52,000. So that's a change of 16.5%. So we are seeing a little bit more active listings on the market. So buyers have a little bit more to choose from than previous years. So the market feels a little bit slower because buyers are feeling a little bit more cautious. They're not putting kind of demand on the seller, and they're kind of sitting back and kind of making sure that they make the right decision. So not because demand has disappeared, it's because they are a little bit more cautious than they have been in the past, because they have a little more to choose from. This year is kind of shaping up to how it felt like in 2025, a little bit slower pace, a little bit more negotiations, and your strategy, when you're either on the buying side or the selling side, definitely does matter than just waiting for the big headlines to hit, like mortgage rates to reduce and so forth. So a little update on inventory and supply. So inventory, like I mentioned before, did tick up week over week, even during a time of year where listings usually kind of a little bit more flat. This time, right after the new year, up until like the hustle and bustle of the spring market, we do see them a little bit of a flat, but we are seeing some more listings hit the market, which is interesting to see. So new listings came around about 50,000 for the week. So this is nationally, so not just Houston specific, higher than it was this time last year. So it's not just Houston that's getting a little more active listings. We're seeing it across the board, but we're still not seeing what we had before pre-pandemic norms. Market with more new construction, especially Sunbelt metros, are where buyers have the most leverage. So we are seeing a little bit more negotiations going on, especially in that new construction standpoint of things. And when it comes to buyers versus sellers, so nationally, sellers outnumber buyers by roughly 47%. This is the widest gap we've seen in over a decade. So that's a very big gap that we've seen. Obviously, the last few years, it's been more of a seller's market where people are able to kind of sell their home in a record-breaking time for record-breaking prices. We are seeing a readjustment in the market. That's not normally the case for the last, probably 12 to 18 months. This is why buyers feel a little more confident when they're negotiating and taking their time and kind of being more selective, and then kind of going a little bit more heavy on, their negotiations, especially in the option period and so forth. Sellers no longer have control of the pace unless their home is priced, bang on to either market value or below market value, and then have all the bells and whistles like the light fixtures to the elevation of the home to the, just standout features. So those are the only ones that we're seeing go very quick in this market. This is one of the most strongest buyer-leaning environments we've seen since probably early 2010s, but without kind of distressed pricing. So it's interesting. We're going into kind of a shift in the market, but at the same time, all positive things, because it's kind of going into a more normal market than we did see the last few years. And then when it comes to builders and remodelers, builder confidence is at a kind of in the high 30s, which is kind of pessimistic for sales, because the scale runs normally from 0 to 100. So anything below 50 for builders feeling this is kind of not a good situation for them. So they're kind of a little bit more pessimistic about the sales. And then buyer traffic is 23 out of 100. So this means, for every 100 buyers, builders expect to see around about 23 of them show up. So this is a little bit of a lack of foot traffic, and kind of reduces the leverage for the builder, and kind of makes it a little bit more leverage for the buyers. Builders are still facing a little bit high construction costs for labor, materials, and kind of insurances, which kind of limits how much they can cut the prices without hurting their margins. So it's very specific to what's going on in the construction side of things. We are seeing that get a little bit wide, kind of working with both builders, buyers, and even sellers for new construction. Because of that, builders are focusing on moving more homes that are already built, like their spec homes, instead of waiting months to kind of build the custom and kind of go through that selection route with that. This is why buyers are seeing a little more incentives like late rate buy downs, closing cost credits, upgraded packages instead of like the big headline price drops with new construction. And then price reductions in foreclosures. So we are seeing roughly 35% of active listings nationally have a price cut. This is up from this time last year. So, with the more listings being on the market, this makes sense. Obviously, we have more to compete with. And when we have more to compete with, obviously, you may need to see a readjustment in the pricing if your home is sitting on the market to get some sort of action and foot traffic through the front door. This is not single a crash. It's single sellers adjusting to more of a competitive buyer-aware market. Homes priced correctly from day one are obviously still selling well, while overpriced homes sit and kind of chase the market. So we have seen a lot of homes just kind of, try to push that test in the market value. Obviously, the buyers push back. It sits in the market. They readjust, and then they, get to the price where buyers are comfortable, moving forward there. Foreclosures filing rose in 2025, totaling around about 367,000, well below 2019 levels and far below 2009 levels. So nothing to be concerned with, but they did kind of rise in 2025. This increase represents a return to a normal market behavior, not a distressed market. So like I said, nothing to be concerned with, but we are seeing stuff rise, but nothing to kind of be, overly panicking about. So banks are not overwhelmed, which is why foreclosures are completing faster but remain controlled. There is no foreclosure wave forming. And then quick take on pending sales and activity. So weekly pending sales top 50,000, a strong kind of early year sign. So that is awesome to see. This is nationally, not just kind of locally. So more pending sales means the market is getting speeding up a little bit. We are seeing this in our own personal business too. We've went under contract over I think 3 or 4 properties this past week, basically the last 2 weeks. So we are seeing a little bit more buyer activity and so forth. But mortgage applications are up double digits year over year for 2 weeks straight. So once again, that means the market is heating up. It's going to be kind of snowballing into the spring as we get more listings in the market, more buyer activity. So it's good that it's starting this early in the year. This suggests spring demand may be stronger than last year, especially if rates stabilize. So if you look here from December 2025 in this table, for the pending sales, you're at that kind of low 5,000 mark. This year, we kind of peaked over that 6,000 mark. So that's a 12% change from year over year from 2024 to 2025. So that is great to see here in Houston that we're getting a little bit more pending sales too. So market's improving overall. Market updates, rates, and economy. So mortgage rates briefly dipped below 6%, but those gains were kind of erased quickly due to kind of market I can't even say that word. Sorry. Rates ended the week around 6.1 to 6.2%, showing fast conditions can change. So obviously these can fluctuate week by week. So it's good to kind of keep tabs so you can maybe lock your rate in when it does dip low before it peaks back up again. So it's something to kind of keep in consideration because it could change, your monthly payment for a significant amount. Quick stats here, 0.25% lower is going to be saving you around about $75 a month for a $500,000 loan, and then 0.5% lower is going to save you $150 per month if you're using a $500,000 loan. So all good things. So inflation, it did, it's around about 2.8%. This means that, prices are still rising. However, it's much slower than it was a couple of years ago. So the pressure of mortgage rates kind of easing a little bit due to the Fed target. But anyway, that is something that's good. It's not kind of increasing as much as it has in the past, but it's still rising slightly. Core inflation over the last 3 months is closer to 1.6, which helps stabilize rates. So, if core inflation is around 1.6 recently, this means kind of like the 10 is moving in the right direction, which helps keep rate from jumping even higher. The job market remains strong with weekly unemployment claims around about 200,000, well below kind of recession levels. So that's very good that households are not kind of going under kind of like widespread financial stress. This combination kind of supports stability, not forced selling or housing collapse. So that is pretty much it for this week's update. So hopefully you found this helpful. Like always, feel free to give me a message if you want a little bit more in depth of any of these topics. Hopefully you're staying warm out there, and have a good rest of your week.